Imagine you are a CEO. You hand your best division manager a highly profitable project that will grow the company, and they reject it point blank. They aren't trying to sabotage the business. They're just following the math. In corporate finance, the metrics used to evaluate performance dictate how managers will behave. By the end of this video, we are going to calculate return on capital employed, or ROCE, step by step to see exactly how business units are evaluated. We will also uncover the hidden behavioral trap inside return on investment and learn how to fix it mathematically using a tool called residual income. Evaluating a division is an exercise in incentive design, where the individual's performance targets are structured to support the survival of the whole. Let's start with ROCE and the crucial matching principle. When calculating metrics, your profit and your capital must be on equal footing. If your capital calculation includes both share capital and long-term debt, then the profit you measure must be the profit earned by all that capital together. That means using profit before interest and tax, or PBIT, instead of net profit. Let's look at Modern Furniture Limited's digital P&L document. We take their revenue of 300 lakhs, subtract the 225 lakhs in cost of goods sold, and get a gross profit of 75 lakhs. Then we subtract the 48 lakhs in admin costs to find the exact PBIT of 27 lakhs. Now, a warning for your exams. Never use closing capital on its own. You need the average capital employed. You take total assets minus current liabilities and average that out between the opening and closing of the year. For Modern Furniture, that gives us an average of 180 lakhs. Finally, we bring the matching principle home. Look at this final calculation. PBIT of 27 lakhs divided by the average capital of 180 lakhs gives us an ROCE of 15%. And as this chart shows, that 15% exceeds the industry average of 12%. Since the furniture industry averages an ROCE of 12%, we have proven mathematically that this division makes efficient use of the cash entrusted to it. But what happens if the market shifts? Suppose the industry average ROCE suddenly jumps to 16%. Now Modern Furniture's 15% is underperforming. If you are taking an SCMPE exam, do not just write that the company is performing worse. Stopping there will cost you up to half of your marks. Qualitative analysis is mandatory. You must write an advisory comment demanding that management investigate the root cause of the drop. You have to ask, is profitability too low due to high costs? Or are there assets sitting idle? Use these exact keywords in your answer. Management must take action to rationalize the cost, revenue streams, or asset base. Raw financial numbers are useless diagnostics unless they are paired with a strategic directive on how to fix the underlying operational issues. This brings us to return on investment, or ROI. Pioneered by DuPont in the 1920s, it remains a standard metric for evaluating investment centers. The creators of ROI wanted to move focus away from the absolute size of a division's profits and instead measure the efficiency of the assets employed to generate that income. To see how this metric can backfire, imagine a manager who runs a successful pizza branch with a 13% ROI. Corporate offers them a new delivery van that generates a 10% return. Since the company's overall cost of capital is 8%, buying the van is profitable for the business as a whole, but the manager rejects it. Because a 10% return is lower than their branch's current 13% average, accepting the van will drag their personal performance score down. In the world of strategic cost management, this exact scenario is called sub-optimization. It ultimately creates a severe lack of goal congruence. Let's look at a dual case study. Manager Alpha rejects a viable 10% project to protect their 13% average. Meanwhile, Manager Beta grabs a 7% project to boost their 5% average, hurting the company since the return is below the 8% cost of capital. For your exams, note this specific flaw. Research shows that ROI has a poor correlation with shareholder wealth, and it is easily distorted by accounting policies. ROI can pit the personal success of the division manager directly against the financial health of the overall company. To solve the ROI trap, we use residual income. This approach moves away from percentages. Look at this formula. It measures absolute cash. You take the controllable profit and subtract a minimum hurdle rate, the cost of capital charge, based on the investment amount. What remains is the residual income. Let's recalculate Division Alpha's rejected project. They have 2 lakhs in controllable profit. Subtract the 8% capital charge on the 20 lakh investment, which is 1.6 lakhs. That yields a positive residual income of 0.40 lakhs. The manager accepts. Now for Division Beta's poor project. Their 1.4 lakh profit minus that same 1.6 lakh capital charge yields a negative residual income of negative 0.20 lakhs. The manager rejects it. Notice the behavioral shift. Manager Alpha now accepts the good project because their cash score goes up, and Manager Beta avoids the bad project to protect their score. Residual income mathematically encourages managers to act in their own interest only when those actions benefit the entire company. This is the definition of goal congruence. You have now diagnosed a company using ROCE, identified the behavioral trap of ROI, and deployed residual income to align human incentives with corporate goals. Let's lock in the core formulas. First, gross profit ratio equals gross profit divided by sales times 100. Next, average capital equals opening net assets plus closing net assets divided by 2. ROCE equals PBIT divided by average capital employed times 100. And residual income equals divisional profit minus the cost of capital times the investment. In strategic management, matching your metrics and perfectly aligning your goals builds a strong foundation for long-term divisional performance.